Good afternoon, members of the press, distinguished ladies and gentlemen. As a background, the reconstituted Monetary Policy Committee held its maiden meeting, the 260th meeting of the committee, its first in 2018, on the 3rd and the 4th of April 2018, against the backdrop of strengthening global growth and improving domestic economic conditions. The committee assessed the developments in the global and domestic economic environments during the first quarter of 2018, including the risks to price stability, financial stability, and economic growth in the short to medium term. 9 members of the committee attended the meeting. The strong headwinds which confronted the global economy in 2017 showed signs of moderation, giving way to prospects for stronger growth in 2018. Consequently, global output is projected to grow by 3.9% in 2018 from 3.7% in 2017 on the backdrop of a rebound in investments as a result of improvements in investor confidence, strengthening commodity prices, rising aggregate demand, and accommodative monetary policy, especially in the advanced economies. With the sustained recovery in oil prices, aggregate demand is expected to continue to firm up. Growth in the advanced economies is expected at 2.3% in 2018 and 4.9% for emerging markets and developing economies. The Monetary Policy Committee noted some downside risks to the outlook for global growth, to include continued normalization of monetary policy in the advanced economies, new U.S. trade policy, uncertainties associated with the Brexit negotiations, and rising geopolitical tensions in the Middle East and on the Korean Peninsula. In the advanced and emerging market economies, inflation is projected at 1.9 and 4.5% in 2018 respectively. However, the broad indication from the International Monetary Fund is that over the medium to long term, inflation may rise at a modest pace as general economic conditions remain subdued. Assets prices and long-term yields in major financial markets are also on the increase, confirming the possibility of a future rise in the price level. Domestic output developments. Data from the National Bureau of Statistics (NBS) indicate that real gross domestic product (GDP) grew by 1.92% in the fourth quarter of 2017, up from 1.4 and 0.72% in the third and second quarters respectively. The economy grew overall by 0.83% in 2017. The main drivers of real GDP growth were agriculture 1.08%, industry 0.56%, and trade 0.35%. Non-oil real GDP grew by 1.45% in the fourth quarter of 2017, compared with a contraction of 0.76% in the third quarter of 2017, indicating that the economy is gradually returning to a path of sustainable positive growth. The committee also noted the continuous positive outlook based on the manufacturing and non-manufacturing purchasing managers index stood at 56.7 and 57.2 index points respectively in March 2018, indicating expansion for the 12th and the 11th consecutive months. Committee believes that effective implementation of the Economic Recovery and Growth Plan by the federal government and quick passage of the 2018 budget will continue to enhance aggregate demand and confidence in the economy. Developments in money and prices. Committee noted that money supply M2 grew marginally by 0.07% in February 2018, annualized to 0.42%, in contrast to the provisional growth benchmark of 10.29% for 2018. The development in M2 largely reflected growth in net domestic credit (NDA) of 24.3%, emanating majorly from net credit to government, which grew by 19.99%, annualized to 119.94 against the provisional benchmark of 33.12%. Credit to private sector also grew by 1.49%, annualized to 8.94% in February 2018, compared with the provisional annual benchmark of 14.88% for fiscal year 2018. Net foreign assets (NFA) contracted by 2.82%, annualized to 16.92%, compared with the provisional benchmark of minus 29.31%. Narrow money M1 also contracted by 2.77%, annualized to 16.62%. The committee urged the federal government to strongly exercise restraint on domestic borrowing in order to lower the cost of credit to the private sector. The committee noted that the continued low level of lending by banks remain a constraint to growth of the real sector of the economy. The committee advised the management of the CBN to continue to provide the required policy impetus to engender improved credit delivery to the deposit by the deposit money banks to the Nigerian economy. Inflationary pressures in the economy continue to moderate, with headline inflation year on year receding for the 13th consecutive month to 14.33% in February 2018 from 18.72% in January 2017. Month-on-month food inflation fell by 133 basis points to 17.59% in February 2018, and core inflation also declined marginally by 38 basis points to 11.71% during the same period. These developments were attributable to the weak exchange rate pass-through to domestic prices. Money market interest rates reflected liquidity conditions in the banking system, as the average interbank core rate increased to 12.42% in February 2018 from 9.49% in December 2017. The open buyback OBB rate also increased to 13.19% in February 2018 from 8.46% in December 2017. The movement in the net liquidity position and interest rates reflected the combined effects of OMO auctions, foreign exchange interventions, and statutory allocation to states and local governments. The committee also noted the continuous improvement in the level of external reserves, which stood at $46.699 billion as at March 29, 2018. Similarly, the oil share index rose by 8.5% from 38,243.19 on December 29, 2017 to 41,504.51 on March 29, 2018. Market capitalization improved by 10.2% from 13.61 trillion naira on December 29, 2017 to 14.99 trillion during the same period. The committee observed that while this development may be a reflection of improved investor confidence in the economy, it cautioned that the management of the bank should carefully monitor the developments and to establish mechanisms to safeguard the stability of the foreign exchange market in the event of a sudden capital reversal. The committee observed the continued rise in oil prices, but acknowledged the inherent volatility in commodity prices and urged the bank not to relent in building external reserves buffers against any future price downturns and as a means of sustaining investor confidence in the economy. The committee noted the relative stability in the foreign exchange market with declining premium across all segments of the market. It observed with satisfaction the sustained high level of activity at the investors and exporters window of the foreign exchange market. The window continues to attract more investors, thus boosting foreign exchange supply, and consequently total foreign exchange inflow through the central bank increased by 73% in February 2018 compared with the previous month. This was attributed to the increase in receipts of proceeds from petroleum profit tax, royalties, and crude oil and gas. Total outflow also increased in February 2018 by 15.69% as a result of higher payments for invisibles, interbank transactions, as well as joint venture cash calls payments. Overall outlook and risks. Forecasts of key macroeconomic indicators give a positive outlook for the Nigerian economy in 2018. This is predicated on the quick passage and effective implementation of the 2018 budget, improved security, foreign exchange market stability, as well as favorable crude oil prices. On the downside, the committee noted the potential impact of the 2019 election-related spending against the weak backdrop of tax revenue efforts, herdsmen-related violence, and rising yields in the advanced economies. Indications in the US and the UK point to higher interest rates in the short to medium term. The considerations of the committee. The committee noted with satisfaction the gradual return to macroeconomic stability as reflected in the third consecutive quarterly growth in the real GDP in the fourth quarter of 2017. It also noted the continued moderation in all measures of inflation, as well as sustained stability in the Naira exchange rate, and urged the bank to sustain the stability to avoid emission drift. In particular, committee welcomed the narrowing of the exchange rate premium between the BDC segment and the investors and exporters window of the foreign exchange market. Overall, the committee noted that the recovery of the economy was strengthening in view of the return to growth of the services sector. As the fiscal sector continues to settle its outstanding liabilities, it reduces its domestic debt profile, thus increasing the liquidity of the banking system. However, the Monetary Policy Committee observed increasing monetization of oil proceeds as evident in the growing FAC distribution relative to the 2017 levels of disbursements. Committee urged the government to initiate strong stabilization programs and to freeze the growth in its aggregate expenditure and FAC distributions in order to create savings badly needed to stabilize the economy against future oil price related shocks. Notwithstanding the general improvement in macroeconomic conditions, committee noted the rather slow pace of moderation of food inflation. It also took note of the potential risks of a pass-through from rising global inflation to domestic prices. Members, however, expressed confidence that the tight stance of monetary policy would continue to complement other policies of government in addressing some of the structural issues underlying the stickiness of food prices. The committee noted that at 14%, the policy rate was tight enough to rein in current inflationary pressures. The committee therefore reaffirmed its commitment to price stability conducive to sustainable and inclusive growth. The committee noted with satisfaction the gradual implementation of the Economic Recovery and Growth Plan in an effort to stimulate economic recovery. In the same vein, the committee urged quick passage of the 2018 appropriation bill by the National Assembly so as to keep fiscal policy on track and deliver the urgently needed reliefs in terms of employment and growth for its citizenry. The committee noted the relatively strong balance sheets of the deposit money banks and the stable outlook. This is in spite of the concentration of non-performing loans in a few sectors, which the committee observed was satisfactorily being addressed by adequate mechanisms established by the bank to address the phenomenon. The committee also noted that as government pays off its huge contractor debts, a sizable portion of these non-performing loans will be addressed. The committee urged the bank to strengthen its supervisory oversight and early warning systems to promptly identify, monitor compliance with extant prudential regulations, sustain macro-prudential policy, and manage emerging vulnerabilities in the banking system. The committee reiterated the bank's commitment to delivery of low-interest credit as evidenced in its bold steps to adopt unconventional monetary policy to aid credit flow to vulnerable and growth-enhancing sectors of the Nigerian economy. The committee therefore enjoined the bank to continue to support and encourage credit delivery at single-digit interest rate through mechanisms in the interim, while encouraging the banking system to establish frameworks to increase credit delivery to the employment-generating sectors of the economy. In consideration of available data and evolving macroeconomic indicators, the Monetary Policy Committee is committed to revisiting its decision in the short to medium term as the fundamentals evolve. Committee's decision. In reaching its decision, the committee appraised potential policy options in terms of the balance of risk. Committee also took note of the gains made so far as a result of its earlier decisions, including the stability of the foreign exchange market, the moderation in inflation rate, as well as the restoration of economic growth. The launching of the Food Security Council by the federal government to improve food sustainability is a step in the right direction. The committee was concerned about the fiscal distortions associated with absence of buoyancy between the GDP growth and tax revenue, and urged the fiscal authorities to deploy appropriate corrective measures to address this phenomenon. The committee was of the view that further tightening will strengthen the impact of monetary policy on inflation, with complementary effects on capital flows, indeed positive effects on capital flows and exchange rate stability. Nevertheless, it could potentially dampen the positive outlook for growth and financial stability. However, the committee of the view that loosening will strengthen the outlook for growth by stimulating domestic aggregate demand through reduced cost of borrowing. This may, however, lead to a rise in consumer prices, generating exchange rate pressures on the currency in the process. The committee also believes that loosening could worsen the current account balance through increased importation. On the argument to hold, the committee believes that key variables have continued to evolve in line with the current stance of macroeconomic policy and should be allowed more time to fully manifest. In consideration of the foregoing, committee decided unanimously by a vote of all members present to retain monetary policy rate MPR at 14% alongside all other policy parameters. Consequently, MPC voted unanimously to retain 1. MPR at 14%, 2. CRR at 22.5%, 3. Liquidity ratio at 30%, and 4. Asymmetric corridor at plus 200 basis points and minus 500 basis points around the MPR. I thank you for listening.